Hi guys, and welcome back to Cash Bright, your guide to investing in an ever-increasingly uncertain financial world. Now, if you're someone who's looking to move away from relying on conventional income and towards establishing your own passive income stream, then listen up. So what do I mean by passive income? Well, active conventional income arises through working, i.e. providing your time, effort and resources to others in exchange for, in most cases, a steady, reliable income. This exchange of labour for money is the basis for the modern day economy, and thus is very important. Think of how important these workers are to our lives, from your local street cleaner to the surgeon who operates to improve or even save your life. Now, most people work, save, hold a few assets like a house, and eventually retire when they are elderly. They usually live out their remaining years from a modest pension and careful control of the purse strings. A small minority of people, however, choose to go down a different path altogether by setting their sights on investing their money in assets such as stocks, which over time will provide a sufficient and reliable stream of passive income on which to live. The income is passive because once it's set up, income continues to be generated absent any material level of work on your part. The most effective passive income plans even allow some to escape the rat race and retire early. Other plans, whilst not generating enough income for early retirement, at least provide supplementary income through time, on top of the principal value of the underlying assets. The most popular way to build passive income is through dividend-paying stocks. Now, a dividend is simply a distribution of a company's earnings to shareholders, as determined by the company's board of directors. It is essentially a reward paid to investors for investing and trusting their money in the company. As long as you own the stock before what's known as the ex-dividend date, you will be eligible to receive the company's dividend payment. These payments can be in the form of cash, additional stock, or even shares in the company's physical assets, such as equipment or real estate. They tend to be paid annually, but may also be paid on a quarterly basis. So in the current economic landscape of low interest rates and undervalued companies on the stock market, I think now is a good time to invest in dividend-paying stocks. When building a dividend stock portfolio, it's important to plan ahead, do your research, and to always factor in the inherent risks of investing in the stock market. Now, when looking at stocks, you will naturally be focusing on what's known as the dividend yield. That is the ratio of the earnings you are getting for each dollar you have invested. But beware, a high dividend yield does not necessarily equal a good investment. This is because there is an inverse relationship between the stock price and the dividend yield. It sounds counterintuitive, but stay with me. Often, a rise in a company's dividend yield is a function of a fall in its stock price. This may in turn be a sign that the company is struggling, and may therefore pay out less dividends in future, or even none at all, depending on the health of the company. In the wake of the coronavirus lockdown, a drop in the number of companies paying dividends can be explained by broader macroeconomic trends. But even in this current context, investors need to be on their guard for such misleading dividend traps. So, how should you be choosing your dividend-paying stocks? Well, before hitting buy, you need to be having a good, hard look under the hood of the company. Are we seeing growth in its revenue and earnings? Does the company have a proven track record of making a profit? And very importantly, to check whether the company is overburdened with debt. All of these factors will affect your dividend income because, of course, such income is never guaranteed, particularly when a company lands itself on the rocks. Cash is king, and so you want to be picking stocks with good revenue numbers that will not only help solidify the likelihood of receiving steady dividend payments, but may also increase the chances of the dividend value increasing in the future. It's worth noting that growth stocks don't make good investments for dividend income, because smaller growth companies need their profits to cover their debts and to reinvest for future expansion. Thus, these kinds of stocks are unlikely to pay shareholders any dividends. Bigger companies, in contrast, with lower growth potential but solid track records, are best for dividends. Finally, when choosing your dividend stocks, you need to bear in mind what's known as the economic moat of a company. Now, this term was popularized by Warren Buffett and refers to the ability of a business to maintain its competitive advantage over competitors in order to protect its market share and its long-term ability to generate profits. This will include companies which have a strong brand and possibly a technical advantage over others. Think about Apple and its strong brand image, and therefore competitive advantage over other cell phone/computer companies. Now, the sweet spot is to find stocks which have decent economic moats, but relatively low or undervalued stock prices. This is what Warren Buffett has been so good at doing during his career, and I think you would not go far wrong to emulate this strategy when choosing your own dividend-paying stocks. Thanks for watching. If you found this video to be helpful, please leave a like and don't forget to hit the subscribe button. And until the next time, stay sharp, stay hungry, and stay cash bright.